Welcome to Decision Vision, a podcast series focusing on critical business decisions. Brought to you by Brady Ware & Company. Brady Ware is a regional, full-service accounting and advisory firm that helps businesses and entrepreneurs make visions a reality.
Welcome to Decision Vision, a podcast giving you, the listener, clear vision to make great decisions. In each episode, we discuss the process of decision-making on a different topic from the business owner's or executive's perspective. We aren't necessarily telling you what to do, but we can put you in a position to make an informed decision on your own and understand when you might need help along the way. My name is Mike Blake, and I'm your host for today's program. I'm the managing partner of Brady Ware Arpeggio, a data-driven management consultancy which brings clarity to owners and managers of unique businesses facing unique strategic decisions. Our parent, Brady Ware & Company, is sponsoring this podcast. Brady Ware is a public accounting firm with offices in Dayton, Ohio, Alpharetta, Georgia, Columbus, Ohio, and Richmond, Indiana. If you would like to engage with me on social media with my chart of the day and other content, I'm on LinkedIn as myself and at Unblakeable on Facebook, Twitter, and Instagram. I also host a LinkedIn group called Unblakeable's Group That Doesn't Suck, so please join that as well if you would like to engage. Today's topic is, should I purchase trade credit insurance? According to the Federal Reserve, U.S. non-financial firms had $4.5 trillion in trade credit outstanding, equal to approximately 21% of gross domestic product. So accordingly, trade credit is the largest form of short-term business financing. And I want to cover this topic today because even though it's a niche topic, it's foundational to the import-export business. And we haven't really done foreign business in a while. I don't remember what podcast number it is. It had been within the first 50 when we had Gene Plavnik on to talk about, should I export? And you know, we didn't really touch upon trade credit there as my recollection. But I think what we're going to find from one of our guests is that one of the key things that allows import-export to go, especially at scale, is the existence of this kind of insurance product. And so if you are whether you are exporting or perhaps even importing now, or you're thinking of doing so in the next couple of years, this is a topic that you're going to want to understand as you go down that path. So joining us today are Janelle Foy and Carlos Garcia of Allianz Trade. Janelle just celebrated 15 years at Allianz. She works in business development and is focused on fostering her clients' aggressive sales growth while protecting against credit risk. And protecting against risk is something near and dear to my heart. Prior to working with Allianz, Janelle spent 7 years in sales and account management for Bell South Business, selling telecommunications services to middle market customers. She's an active member of multiple professional organizations and currently serves as president of the Secured Finance Network Atlanta chapter. For 15 years, or over 15 years, Carlos Garcia has been consulting with a variety of companies in diverse industries to help them navigate the growth of their business. As part of Allianz Trade, Carlos has access to a wide range of business-to-business trade receivables protection and credit management solutions, including credit insurance and debt collection. Carlos's goal is to leverage the knowledge he has amassed over the years to help clients deal with the inevitable hiccups that happen while growing their business. Headquartered in Paris, Allianz Trade is present in more than 50 countries with over 5,500 employees. A member of the Allianz Group, they are a strong global community committed to a culture where both people and performance matter. Janelle and Carlos, welcome to the Decision Vision podcast.
Thank you for having us.
Thank you for having us.
So tell us, let's start off with something very basic, because I think a lot of our listeners are not going to necessarily be familiar with this topic. What is trade credit insurance and why do people buy it?
Well, trade credit insurance, it's very, very easy to understand, but a lot of people want to make it very difficult. But it's imagined, to use something that everybody discusses and knows, brands, Samsung. So let's say Samsung is going to go and sell, $100,000 worth of TVs to Best Buy. What we insure is that if Best Buy goes bankrupt, disappears, slow pays, or there's any type of political risk, if they're in an export market, we're going to pay them 90% of that loss. So it's basically an insurance when you give a customer terms.
Now, I think something that'll be helpful is to explain to our listeners and to me, because I don't do a lot of import-export. I have some sales to foreign customers, but nothing of the magnitude you guys deal with. How do import-export deals generally work, and where does trade credit insurance fit into that process?
Well, from a import-export, okay, once you import the product, if you're distributing it within the U.S., okay, the minute that you reach out to us where we would approve a buyer, okay, as soon as you cut that invoice and that product has left your warehouse, at that point is where the receivable starts and the insurance begins. On the export side, it basically starts once either it goes to the freight forwarder or you deliver it directly to the customer. That's where the insurance starts when you've lost control of the product.
And so how does it work? I mean, to me, it's fairly obvious about how this works from an export perspective, right? You sell something, you sell something, you expect to get paid for it. Something happens, all of a sudden, you don't think you're going to get paid. That's where the insurance comes in. But what about on the import side? How does trade credit insurance work on the import side?
Well, it's not a product for the import.
Oh, it's not. Okay, I want to make sure.
Right. Once you import the product, what you're going to do with that product. So if you're going to sell it to a customer and give them terms to pay you, for example, within the U.S., that's where our insurance starts.
Got it. Okay. So what are the reasons that deals go badly? What are the most typical reasons that your insurance is ultimately called upon?
I think, like you had mentioned before, when you talk about that 4.5 trillion in trade credit outstanding, essentially when you give somebody 60-day terms, you're giving them a loan. It's basically a small business loan. A bank would never do that without getting collateral, without getting financials, without getting, credit terms, all the information that they need. But buyers expect you to do that on virtually no information. So what credit insurance does is essentially provides that collateral for the loan. We're going to help you know if that customer is a good customer and a strong one to work with. And then if in the end they don't pay you, we're going to cover you and pay you for
it. And is there something, not being paid by a customer is something that is a risk, of course, whether it's an international or domestic deal. Why is that risk different when you're exporting to a foreign country versus, say a deal between a company in New Jersey and a company in Indiana?
Well, the biggest thing is because we cover political risk. So if you're shipping overseas and there's a political risk situation, that's the biggest thing of exporting, why people require the insurance or the financial institution requires the insurance. It's because of that political risk factor.
Okay, so let's dive into that, because I think it'll be helpful for our audience to get granular. What are some examples of a place where political risk puts being paid at risk?
A real easy one, for example, is a couple of years ago when Argentina or Venezuela said, hey, you're not pulling any money out of the country to pay a U.S. debt. So a situation like that where the government gets involved and either seizes, the products at the port or says, hey, there's no money coming out of here to pay a U.S. debt. Those are political risk events that would cause our insurance to trigger and cover that.
So
yeah, another timely example is sanctions in Russia. We had a client with a barge full of perishable goods that were shipping into Russia. We put the sanctions in place. They were no longer able to deliver those goods. So that then becomes a political risk claim as well.
I'm glad you mentioned that, because I was going to ask about that. One day you're able to do business in Russia, another day that another day you're not. And to me, the interesting risk that or dynamic that political risk brings into these deals is you may have a customer who is perfectly willing and able to pay, but because of some policy intervention, right, they may not be allowed to. Now, Russia's interesting in that the policy intervention has not been within Russia itself, at least not initially. It's been on Western countries, including the United States. But the more classic case for what you described in Latin America, where they put in currency controls, for example. The point is that even with the best of intentions, the customer may simply be legally prohibited from paying, even though they can and want to do so.
Right.
So, you bring Argentina. I'm curious about this. Argentina is a very interesting case because I'm old enough to remember at least 2 debt defaults. Right. And I'm old enough to remember at least 2 currency devaluations where another comma was put on the dollar, on the currency, maybe 2 commas, in fact.
Right.
Once, I'm curious, in your experience, once a country kind of commits those acts, which then force you to bring your insurance, compel you to pay out insurance claims, how long does it take to get comfortable to go back into that country? Because it's kind of interesting, right? How short memories we have when, during the 1980s default, the chatter was, well, Argentina can't default because nobody will ever put money into the country again, right? Within 5 years, it was as if nothing had ever happened. I'm curious about that phenomenon. Is it, I know this is kind of a philosophical question, but it just fascinates me. If you're going to be an international risk, international credit, do you sort of have to have a short memory? Does that come with the territory?
Absolutely. From every aspect of what we do, we have a short memory. Our underwriter, our head underwriter tells me that all the time. When we go through difficult times and I tell him, hey, Steve, do you think we learned that and we're not going to do this again? And he tells us, hey, we're going to have short memory and we're going to do this and worse because you never know what's going to happen. And in the situation with Argentina, sometimes we come off the political risk. Currently, we're off the political risk. So if you purchase credit insurance in Argentina, for example, we tell you, hey, this is excluding the political risk factor because the chances of there being a political risk event in today's world in Argentina is extremely, extremely high. So but we do have very short-term memory when it comes to things.
And ultimately, we are in the business of paying claims. So we can't live in a no-risk market. Ultimately, we do pay claims to our clients. So we have to take on some level of risk.
So I'm also curious. We hadn't discussed this before, but we talked about Argentina, we talked about Russia, places which historically, let's just say, have had some volatility to them. Do you ever write policies with more frankly stable political environments, maybe even somebody in the G20 or the G7 that we wouldn't ordinarily have political risk, but maybe there's a perception in a niche area where there could be political risk? Or is it purely for the so-called developing world?
Political risk for certain countries is very valuable, but when we look at foreign receivables, there's multiple reasons why companies buy them. A lot of banks will not lend on any receivables any foreign receivables that aren't insured. So it'll help improve a borrowing base and their lending capabilities. But in addition, as much as we insure foreign receivables, we also insure domestic. So companies look at it for a credit management tool. They look at it for an insurance product. They look at it to just protect the risk that is out there, regardless if it's in Argentina or Germany, the risk is still there. And the ability to go collect a receivable in Germany is going to be just as difficult as going to Argentina and collecting it. So that's where we kind of step in and make sure they're going to get paid for those receivables.
Okay, yes, that's really interesting too. So the political risk is not limited to a foreign or a distinct policy, but simply the risk of trying to collect on a judgment in a foreign judicial system is something that also is insured against.
Well, not
Absolutely. So
yeah, it's got a default. What we cover, with the easy way to understand it, is we cover the inability to pay. Not I don't want to pay, but there has to be, hey, I can't pay for XYZ reason. Not, hey, I don't want to pay because, the product was bad. No, there's got to be an inability to pay.
Got it. Okay. So let's say somebody's been listening to this and they're thinking, oh, I really ought to think about trade credit insurance. I just didn't know that this existed or hadn't learned anything about it. What is the process like to apply for an insurance policy from you guys or somebody similar to you?
the process is really pretty simple. It's an application and a recent copy of their aging report. Oftentimes we can help them complete the application, but it's a pretty simple process. Turnaround, we can do it in 5 to 10 business days. So we can have a quote for them and a proposal in front of them pretty quickly.
And over time, does a relationship with the customer matter? In other words, is it easier once you've done a deal or two with a particular customer? Do you find that it's easier to underwrite more policies for that person? Is there benefit to that relationship to go back to for example, you guys, Allianz or somebody else? Or is each opportunity purely a standalone exercise that's evaluated on its own merits?
So we don't generally write transactional policies. When we write a policy, it's usually for a 1 to 2 year term.
Oh.
The idea being that then we bundle all of their customers in, or a portion of their customers, and we continue to insure those for the policy period. So unlike, say, a letter of credit, where for every transaction you have to get a new letter of credit, with credit insurance, we set a policy in place and you're covered and insured for all those buyers for the policy period.
Okay, that's interesting. So I didn't know that. I presumed that these would be transaction-based policies, but in fact, you'll write a policy for all transactions, presumably between, excuse me, a customer and all their customers in one country for a fixed period of time. Is that how that works? So like if I were going to do business in Germany, for example, that you'd be writing a 1 to 2 year policy on all the business that I do in Germany over a 1 to 2 year period?
Essentially, we underwrite at a buyer level. So they would let us know they're doing business with ABC Company. They would tell us how much they need that insured for, and that goes to our local underwriting department. So we have, like you had mentioned earlier, we have offices in 50 countries. We cover 200 markets. So if you have a customer in Germany, that request goes to our local German risk department, and they determine whether or not that customer is insurable. So in addition to the insurance, you're also getting a credit management tool that helps you understand if a company is insurable. We continue to monitor their risk throughout the policy period. And you know that ABC Company is insured for X amount of dollars. So you know based on that policy exactly how much coverage you have on that particular buyer.
Oh, I see. Okay. So this is it's really focused on one particular trade relationship over a period of time, right? One buyer, one seller.
Coverage is at a buyer level. The policy itself is a combined of all those buyers, a combination of those buyers together. Understood.
So that brings me to another question I want to make sure to ask today, because it seems to me that bringing in trade credit insurance can actually have a useful sort of collateral, no pun intended, but collateral impact in that what you do must be a great source of due diligence, right? And that's got to be one of the hardest things with a new foreign customer. How do you kind of check them out? Is there a German or an Austrian version of D&B or Hoover's? Does that even matter anymore?
Right.
But your analysis can be very useful tactical intelligence to the customer.
Exactly. We're like, easy way to understand it, we're like their credit manager with a checkbook. So if your credit manager makes a mistake, you can't go to them and say, hey, you made a mistake. I need $200,000 for this loss. That's what we do. If we review the buyer, look at their financials, in some cases, make a decision. If we make a mistake, you receive a check.
So now, most of the time when we talk about doing foreign business, I think we tend to I think we automatically think about selling products to foreign buyers. But in point of fact, of course, America is a pretty big exporter of professional services abroad, especially architectural services, among others. Can services be insured in this way as well?
Yes. Any service, any product, as long as you give terms, 30, 60, 90, 120 days, we can insure it.
Okay. And I'm curious, this may be a silly question, but it occurs to me that I wonder if in the terms of a particular transaction, there might be a question or a discussion over who actually pays for the insurance policy, right? Is the insurance policy going to be paid for by the seller or the buyer, maybe both, depending on the structure of the transaction? Is that a thing, or does the seller always pay for the insurance, or maybe the buyer always pays? I truly don't know.
As a general rule, the seller will pay for the policy, but I've certainly had situations where a bank has required credit insurance and the bank has paid for the policy, a parent company, even the insurer's supplier. There's multiple cases where somebody else may pay for the policy, but generally, as a rule, the supplier, the person that owns the policy and manages it, they're the ones that pay for the premium.
Okay. And how long does it take? So let's say somebody wants to take out insurance on a particular trade activity. How long does it take from somebody contacting one of you guys to assuming that a policy is writable, that works out? How long does it take to go from phone call to being insured?
2-3 days.
How much?
2 or 3 days.
Oh, 2 or 3 days. That's pretty quick. Yeah. So you're not going to get in the way of a transaction happening.
No, absolutely not.
Now, within the context of political risk, does that in any way cover currency risk, or is that just a totally separate thing?
Yeah, it's separate. We don't cover devaluation of currency.
Okay. So, in an insurance policy like this, how are they priced, or how is the pricing expressed? And what I mean by that is, I have car insurance, right? So I just pay a number of dollars per month, right? But I think there's certain other kinds of insurance or financial instruments that are expressed as a percentage of the amount of the transaction or expected transactions over time, or maybe something else. So can you talk to me about kind of what the model looks like in terms of pricing these policies?
The policy goes based, most of them, okay? They go based on an insured sales volume annually, and then it's a percent. So to give you a little bit of an idea, let's say a company comes up to us and says, hey, I want to insure my receivables. My sales on credit are $10 million a year. Our underwriter will come back and say, okay, your rate's going to be 1/4%. We take 1/4%, multiply it times 10 million, and it's 25 grand a year. And we give you two options. Either one, you can pay it in full, or you can finance it at 25% down in quarterly payments. It's basically that simple. We do have policies that are coverage based on, for example, single debtor transactions. Hey, I need a big hot topic now is the cruise line. Hey, I need, $5 million on cruise line. We'll tell them, okay, it'll cost you, 0.42% a month. So that we have two options to price policies.
And are the sorry, go ahead, Janelle.
Well, I was just going to say, I think one thing to point out that's a big misnomer in credit insurance is you do not have to insure the entire portfolio.
Right.
So if you only want to insure your export business, if you only want to insure key accounts, we can carve out that business. And essentially every policy is customized for the customer's needs. So depending on what they're looking for, we can structure a policy to meet their needs.
And do the terms vary at all in the policy? My world is M&A. So I tell clients all the time that in an M&A deal, price and terms are dancing partners, and you might get a better price, but you may have to give up more strict terms, or maybe from an insurance perspective, maybe there's a quote higher deductible, right, in order to lower your fees. Does that kind of conversation happen in your world, or are the terms pretty much standardized no matter what what you're insuring?
No, there is a little bit of a wiggle room. Increase in deductible and increase price share. But at the end of the day, there's got to be there's a cost to turn the lights on. So it's not like, hey, at some point we're going to say, it doesn't matter if you lowered that another 20%, it's still not going to change. It's not going to change the price.
So when a customer approaches you for an insurance policy like this, what sorts of information are you going to be requesting to review?
So on the application, the information is pretty simple. We're looking at the annual sales of what we're insuring, when we talked about being able to segment your business. So we look at the annual sales. In the event of foreign receivables, we look at how those break down by country. We look at the industry you're in, your loss history, the terms you sell on. All those things kind of rolling together to determine the premium.
So is there a minimum not transaction? I keep thinking transaction. That's not right. Mm-hmm. Is there a minimum amount of sales volume? Let me put it that way, or even a maximum sales volume that you or others like you will consider?
No, there is no minimum. What we have is a minimum premium. So for a domestic policy, the minimum premium is going to be $10,000. For an export policy, it's going to be $15,000 because of the coverage of the political risk. Okay. And basically, there is no maximum.
Okay, so then at that point, customers will self-select that. Obviously, if it's a $10,000 transaction, spending on insurance doesn't make any sense.
Exactly.
Interesting. Okay. So I think one of your competitors, either directly or indirectly, is going to be somebody like Exim Bank or Media over in Japan, things of entities of that nature who are designed to be in particular export promotion entities. And if I'm not mistaken, they also provide some sort of trade credit insurance, typically based on political risk. How do you coexist with them, or where does it make sense to come to you guys versus to go to an Exim Bank or a similar authority? How do you help clients kind of navigate that decision?
Exim Bank really was developed to help support small businesses. And really where its strength is at that transactional level, like you were talking about earlier. So if you do 4 or 5 transactions a year, small export business, that's where XM really does well. Once you start getting into regular business and you really are doing a decent amount of volume on the export side, at that point, private insurance is going to be more cost effective. We also have the access to more information. So we have the risk underwriters throughout the world that are providing the data that somebody like an Exim Bank wouldn't be able to offer. And in addition, we don't have requirements for where the products are made. Exim requires that a large portion of it be manufactured here in the United States. And also we can cover domestic receivables, and that's something that Exim can't do.
How does a company prepare to work with somebody like you? What do they need to do in order to make your job easier so you can quickly and effectively put an insurance policy in place?
Basically, it's very, very easy. All we're going to ask them for, like Janelle said, that information on the application. But moving forward, all we ask them is for 3 pieces of information. What's the name of the customer you're going to sell to? What's their address? And how much you need? That'll go to our underwriting team. And on the U.S. side, from instant to 48 hours, you're going to get an answer. One of 3 answers. Either 1, the buyer's insured for that amount. 2, the buyer's insured for a lesser amount and the reason why. Or 3, hey, stay away from this buyer. They're not insurable and this is the reason why. On an export, it's a little longer. It could be from instant to 5 days with the same information. So from a customer's point of view, it's basically from taking it from a situation where they're going from the credit manager, sitting on their desk to review it, to maybe going to the credit manager, he or she looking at it, putting it in our system, making a decision, and now they can make a business decision. Do they want to still sell to that buyer or not? So it's really not a lot of, effort that they got to put on their part to get a transaction insured.
I'm talking with Janelle Foy and Carlos Garcia, and the topic is, should I purchase trade credit insurance? So a question I like to ask on almost every show is who shouldn't get trade credit insurance? Is there a profile of somebody that maybe should be thinking about it, but you kind of tell them, don't waste your time. This probably isn't the right kind of product for you.
Customers that don't give credit to their customer. Someone that does prepaid, COD, on delivery. But as soon as they want to grow, the only way to grow is for them to start giving terms to their customers. At that point, they have to come get the insurance. I would say anybody that's got an accounts receivables should have credit insurance.
So are there countries right now that are basically on a no-fly list? Are there countries that you just pretty much an application is going to be dead on arrival that you just can't, that risk is just simply uninsurable?
Well, in my world out of Miami here, the biggest one is Venezuela and Cuba.
Okay.
Those are no non-starters.
All right. So this has been a good conversation. I've learned a lot. I'm sure there are questions that I should have my listeners would have liked me to have asked, or that our listeners would have liked us to spend more time on. If somebody wants to contact you for more information about this topic, can they do so? And if so, what's the best way for them to do so?
They can just, I'm sure you're going to provide, our email and phone number. Janelle and I are regularly available. They can just shoot us an email or give us a call. And if we don't answer the phone on the second, within 24 hours, they'll have a call from us.
That's going to wrap it up for today's program. I'd like to thank Janelle Foy and Carlos Garcia so much for sharing their expertise with us. We'll be exploring a new topic each week, so please tune in so that when you're faced with your next business decision, you have clear vision when making it. If you enjoy these podcasts, please consider leaving a review with your favorite podcast aggregator. It helps people find us so that we can help them. If you would like to engage with me on social media with my chart of the day and other content, I am on LinkedIn as myself and at Unblakeable on Facebook, Twitter, Clubhouse, and Instagram. Also, check out my LinkedIn group called Unblakeable's Group That Doesn't Suck. Once again, this is Mike Blake. Our sponsor is Brady Ware & Company, and this has been the Decision Vision Podcast.